What's up, everybody? Welcome back to the Seven Figure Flipping Podcast. On today's show, I'm going to be talking all about taxes, how to make as much money as you can and save as much money on taxes. Now's the time of year that I know this is going to be really powerful and important for you. So I hope you guys enjoy.
My name is Bill Allen, and I'm the leader of a group of elite house flippers and wholesalers called Seven Figure Flipping. We don't brag or show off our success, but instead let integrity and stewardship be our guide. We are dedicated to helping people unlock the freedom they desperately need. If you ask other real estate investors, they will say to keep your secrets quiet. But we believe in abundance, not scarcity, and that's why we are the elite. We are Seven Figure Flipping, and this podcast is our playbook.
Pretty much every day, somebody asks me about taxes. So how do I save on taxes? What are some tax strategies that you use? And while I'm not a CPA or a tax lawyer or attorney, I have just been doing my taxes for a very long period of time. I study the tax law. I read things. I love to learn about taxes. And what I'll say to everyone that's listening is nobody treats your money the way that you're going to treat your money. It's not even your CPA, an attorney. They are not going to treat your money the way that you would treat your money. So this is a skill that you have to learn. And you've got to take responsibility for your own financial world, your financial life. And this is why we talk so much about finances. This is why we teach so much about money. This is why we're teaching our youth and our young people about money so that they can make a lot and keep a lot. So it's not just what you make, it's what you keep. So the first thing that I'm going to say about taxes, and in this show, I'm just going to go through some bullet point. I'm going to make it as short as I can. I do a call inside of our Altitude program every single year about tax strategies where we do deep dive into this. I talk about what I'm doing on my taxes. So if you're interested in that, you can go to sevenfigurealtitude.com, fill out an application. We also invited the Runway group in there this year and our multifamily mastermind. So you can go to sevenfigurerunway.com and fill out an application. Jump in there. You can get access to the recordings and anything that I've done over the past 7-8 years inside that program. So, okay, let's jump in. So the government wants you, like they reward taxes. The tax code, this giant document, is basically a playbook of what you can do and what you can't do. So it's like, this is the rules. They wrote them in there. The rules are, if you follow our rules, you can pay less taxes. So starting a business is like the best thing that you could possibly do. I'd say starting a business and becoming a real estate professional. Those two things have huge implications on your taxes. The government wants you to start a business because you'll pay more payroll taxes, you'll pay more Social Security, Medicare, which is like FICA, all that stuff. So I pay a ton of payroll tax. While I don't pay a lot of income tax, I pay a lot of payroll taxes to my staff and my team. So being a business owner, they give you a bunch of benefits. So if you haven't started an LLC and started a business, you need to. I'll put a link in the show notes for my friends at Prime Corporate Services. You can go to primecorporateservices.com/7FF, the number 7FF, and they can just give you a call. You can do a free call with them, free strategy call, and you can go into some of your tax strategy because they have tax accountants and things like that on the call. They can do your books, they can do their CPAs on board, and then they can also set up an entity for you. So the first step I would do is set up an entity so you have a legitimate business. And then you can start writing things off on your taxes. You can actually prove the fact that you are starting a business and growing a business, even if you haven't made any money. I get questions all the time. I haven't made any money. I'm in the Runway program. I bought some books. I bought a course. I went to an event. Can I write this stuff off? So that is a great way to be able to defend that with the IRS, that you're starting a business, you're growing this business, and you bought a coaching program, you bought a mastermind group, you bought an event ticket, you got a plane ticket, you bought some food where you talked about the business, things like that you can start writing off on your taxes. The first step that I would say is to start an entity. And you can do that. Prime Corporate Services, they got an opportunity for you to do that. We'll put the link in the show notes for you. Now, here's what anyone can do. So anyone, and I'm just going to kind of rattle them down and explain them, but I'm not going to go into deep detail. You can look up some of these things all over Google, on YouTube. There's tons of places where you can go deeper if you need to. The first one is tax loss harvesting. So tax loss harvesting. So effectively, if you got some money in the stock market, or it's possible that you could do this in crypto too, you would sell your stock at a loss. So if you have losses in your stocks, then you would have to buy something else that is different. So it can't be a like kind exchange. So as long as you find something that's different kind of stock that's structured slightly differently, where they don't do a wash sale. So you don't want to have a wash sale. where it's the exact same thing that you're buying. So you can't sell something and then buy a very similar look-alike stock right afterwards. And so I used to do this in mutual funds all the time. I would do tax loss harvesting. So if the market went down, I would harvest my losses. So I'd sell that stock or bond or mutual fund or whatever it was. And then I would buy something that doesn't trigger the wash sale. So something that's not exactly alike or too similar. So that's tax loss harvesting. Great opportunity for you to have some sort of capital losses. The next one is a retirement plan contribution. So if you have a 401k, you can invest in your retirement plan. So a Roth 401k is after-tax money. But a traditional 401k, one of the best things that you could do is build a solo 401k and max it out. So solo 401k where you do a Roth contribution and then the company match is a traditional 401k. And that's pre-tax money that can be written off against the business. Great opportunity for you to do it. You might be able to do a traditional IRA, but I am always a big proponent of the Roth IRA, after-tax money Roth IRA. And a lot of people say they make too much money for a Roth IRA. It's not true. There's something called a backdoor Roth IRA. So regardless of how much money you make, you can still invest in a Roth IRA. So don't let anybody tell you that you can't do it. Just look up backdoor Roth IRA. Now, for business owners, here's some things that I like to talk about that I've used in the past. A Section 179 deduction, also known as the SUV tax. So this is effectively buying a vehicle over 6,000 pounds and using it for business. So Section 179 deduction. It could also be, you might have a contracting business where you can buy a work truck or a cement truck or I bought like tractors and ATVs and things like that for my farm that I need on the farm, and I can write that off as a Section 179 deduction. The next one is income shifting. So you can income shift the money from you to somebody who's in a lower tax bracket. An example of that would be your kids. So could you pay your kids for some things that you're doing inside the business? Your kids effectively can be, if they're under 18, even if they're over 18, they can be offset on their taxes. If they don't make any other income, you could pay them a W-2 wage up to about, somewhere in the $15,000 to $16,000 range, which is the standard deduction, and be able to write off they're in the 0% tax bracket, and then that reduces your income burden by $15,000 to $16,000 per kid that's coming out of the business. Now, just keep in mind, you're going to give them this money. So it's not like you're paying them that money and then they're giving it right back to you. So the thing that your kids could do though is, write a contract, make them a real employee, make sure they're doing real work and they're paying a reasonable wage. And then those kids could then pay for the things that you're paying for. So they could pay for their daycare, they could pay for their school, they could pay for their books, they could pay for their sports, they could pay for movies, they could pay for all kinds of stuff that they do. All the stuff that you're buying your kids right now it's basically 0% tax money that your kids would spend on things that you're already spending for them. So it's a great way to income shift because you're already paying for your kids. So like I'm going on a cruise this week. My kids are paying for their own room and board on the cruise, $1,000 each. So that's something to think about. The next one is events, mastermind, and travel. So if you are a member of our mastermind, then figuring out how to pay for those things that you're going to pay in maybe January or February anyway, now in November and December. Or join, like paying for an event that you're going to go to next June or April or October or December, and you're buying that in 2023. You're going to buy it anyway. And so why not move it into a year that you may have made a lot of income, and then you can write it off on the business. So events, mastermind, travel, like buy some flights right now that are fully refundable, that if you can't go in the future, you're canceling them, but you're buying them in 2023 and you're getting that tax write-off now. That's an option. Like a lot of masterminds, you might be paying monthly payments and then you can pay it in full. We give a discount to our members to pay in full. So you could actually save like $3,000 to $5,000 by paying for your membership in full before the end of the year. And I don't pay a lot of taxes, so I have no problem with people shifting their income over to us. You're going to pay for it anyway over a longer period of time. Why not pay it in full now and increase your tax write-offs for the year of 2023? So those are a couple things to think about. Books. You can go to 7ffbook.com. You can get my book. It's free and $7.95 in shipping. But the 500K challenge, our runway program, this is a great time to join a mastermind. We're going to start talking about our kids mastermind that we're launching here coming up. And it's a great opportunity for you to join the mastermind that we have for families that are coming out. So things like that. Think about that and to move it into 2023 and have it a business expense, and then enjoy all the perks of that in 2024 where you make more money. The next one is an HSA, health savings account. So this is a great opportunity to have a write-off. You have to have a high deductible health insurance plan to be able to use this, where it's compatible with an HSA. But an HSA is a great way to write off some income by investing in a health savings account. You can buy things out of that account, like any medical expenses or things that you have, or that are related to medical things that you need. I've seen as far as like people getting a pool. So I'm not condoning that or saying that you can, but I've seen people use their HSA for things like that because it was a medical reason with like physical fitness and personal training and stuff like that, like rehab for injuries. Okay, the next one is payroll runs. Like I like to do this. I like to move my payroll into the previous year. So if I'm going to make a payroll run in like January 3rd, then why not make it on December 30th or December 29th? So just moving some of the expenses. The other thing would be buying items early. So I could buy some things in this year that I would pay for anyway. Maybe it's some prepaying some marketing or something like that. The next one is Section 280A, which is the Austa Rule, saying that you can rent out your house or a place from your business and not have to pay tax either way. So you can write it off for the business and not have to pay personal tax. So you can rent out your personal house or an Airbnb or something that you have for up to 14 days and not have to pay taxes on it. So it's a great opportunity for you to use the Austa Rule. Getting towards the end here for real estate professionals. So a real estate professional is like the coup de grace of the tax strategy and tax code. So if you can be classified as a real estate pro, which is over 750 hours a year and more than 51% of your time being spent on real estate related activities, then you can be classified as a real estate pro. What that means is you can offset your active income with passive losses, which is unheard of anywhere else. So if you made $1 million and you had $1 million of passive losses, then you can write off all your income with passive losses. And that's the biggest strategy that I've used for the last few years to pay the least amount of tax possible. I invest in a lot of apartment syndications that I can then write off on my taxes. And if you're looking for something like this, right now, I'm actually raising $9.6 million for an apartment building. And I can talk about it on here because you have to be an accredited investor to join me. So if you want to invest with me and my partners, Jason and Chad and Peely, we have a great deal in Murfreesboro, Tennessee that you can get great depreciation from. We're projecting about 56% depreciation in the first year in 2023. So if you invested $100,000 in as an example, there would be a $56,000 K1 loss that you would get, and you can use 80% of that this year on your taxes. And next year, like in the first 2 years, we're seeing 77% depreciation, which is crazy. We're passing all the depreciation on to limited partners and the passive investors in this deal because we have so much depreciation from all of the other stuff that we do. We're passing everything on to the limited partners, which is unheard of typically in the business. So if that's something you're interested in, you could just respond to this email and say, hey, I'd like to find out more about the deal that you have in Murfreesboro, Tennessee. And if you're an accredited investor, this is a 506C offering that we have. So I can actually talk about it publicly on the podcast. You'll see emails about it, and you'll see it on my social media. So to be an accredited investor, you have to have over $1 million in net worth, not including your personal residence. Or if you're married, making $350,000 a year the last 2 years and likely to do that same thing this year. Or if you're single, $250,000 the last 2 years and likely to do that same thing this year. So if you meet those criteria, then this is an investment that you could make even if we've never met before. The 506C offering. So what you can do is you take that depreciation. So let's say so as an example, you put $1 million into this deal, right? You get $560,000 in depreciation loss on a K1 this year. And you can use about 80% of that. So you're like 480, right around there. And then what you're doing is you're offsetting all of your income with that. So yeah, you got to put $1 million in, but that's $450,000 to $480,000 that you can write off on your taxes that you're not paying to the IRS this year. And we're projecting that deal doubles a 2.13 time multiple in 7 years. So not only are you not paying the IRS, you're doubling your money in 5 to 7 years. And you're getting an annual return of about 16%. Like that's insane. And that's what I do. That's how I can classify it as a real estate professional, and I can write off my active income because I invest so much in apartment syndications. Now you can do the same thing with Airbnbs and short-term rentals. You can do a cost segregation on those properties and take bonus depreciation into account and move it up to year one. What bonus depreciation does is it takes all the depreciation over the length of time and it moves it up into the first few years of the investment. So that is something that I've used for the last 8 years is investing in limited partnerships and syndications where I can get these K1 losses and write-offs that I can put on my taxes to pay less tax. As a real estate professional, like I said, the best part is you can offset your active income. So those are a few things that you can do. Hopefully it's helpful. I know it was quick and I went very high level on it. I get way nerdier in our altitude and runway and multifamily groups. Last week, I did this call for them and I went a lot deeper, answered questions, things like that. But if you're paying a lot of taxes, what I would recommend is you listen to this podcast a few more times and you figure out how to do some of the things that I just shared. And this is not the only thing that you can do, but these are some of the things that I've done. And I really try to only talk about what I've done and say, this is what I do. This is something that you could think about doing, and then you decide for yourself what's best for you in your tax strategy and your big picture tax plan. Keep in mind also, right now, you're not strategically planning for taxes right now. What you're doing is you're really trying to correct for the direction that you've been going. My recommendation is that you do that right now. Like, what is something I can do right now? But you also strategize for next year. What I mean by that is, how much money do you think you're going to make next year? How many write-offs do you think that you're going to have? And strategically throughout the year, starting in January 1st, you start mapping out the plan for how you can strategically not pay a ton of taxes, especially if you're going to make a lot of money. So every year, people come to me and like, oh, I need a syndication. I need some depreciation at the end of the year, like December 25th. It's like, well, why didn't you start investing in our deals all year? Why are you waiting till the end of December to scramble to look for a syndication, and you're just going to put your money anywhere that'll take it? So think about that. We've got a deal and an opportunity right now. I would love you to be a part of it. If it makes sense for you, you can just respond to this email or email us at info@sevenfigureflipping.com, and I'll take a look and get you more information on the deal, more details, and send it out to you. Thank you. Have a great day, and I'll see you on the next show.